I was looking at a pay stub the other day. Not mine, but a friend's who lives in New York City. And the deductions column looked like a crime scene. Between federal tax, state tax, city tax, and FICA, nearly half the money had vanished before it even hit his checking account. It feels like you are running a race where the finish line keeps moving backward by 40% every time you get paid. But then you look at the headlines. You see billionaires paying an effective tax rate that makes a schoolteacher look like a venture capitalist. It is frustrating, right? You start to wonder if there is a secret door you just haven't found yet. But here is the thing I have realised after years of studying money. There isn't a secret door. There is just a completely different building. The tax code was written in a language that translates income very differently depending on how you earn it. If you work for a paycheck, you are playing a home game against the house. If you own assets, you are playing an away game where you make the rules. Before we dive into the mechanics of how this actually works, take a second to subscribe and like the video. Think of it as the best ROI on your time today, investing just a second to beat the algorithm's inflation and get this knowledge out to more people who need it. What we are going to break down today isn't about evasion. Evasion is illegal and gets you a jumpsuit that matches the cafeteria trays. We are talking about avoidance, which is the art of reading the rulebook better than the referee. We are going to look at the buy, borrow, die strategy, the magic of depreciation, and why losses are sometimes better than wins. Most of us grow up with a very linear idea of money. You work an hour, you get paid for an hour, and the government takes a slice. It is simple, predictable, and from a tax perspective, it is the most expensive way to live. I call this the W-2 trap. When you are a high-income earner, say a doctor in Dallas or a lawyer in Chicago, you are actually the ideal tax subject. You are easy to track, your money is liquid, and you have very few places to hide it. But the ultra-wealthy do not have income in the way you or I think about it. They have wealth. And in the United States, we generally tax the flow of money, not the pool of money. This is the fundamental disconnect. If you have $1 billion in Amazon stock, the IRS sees $0 in income until you sell it. You could be worth more than the GDP of a small island nation, but on your tax return, you might look like you are barely scraping by. This isn't a mistake in the system. It is a feature designed to encourage investment. The government wants capital to stay locked up in businesses, building factories and software, rather than being cashed out for yachts. Or at least, that is the theory. The reality is that this structure creates a playground for those who can afford to leave their money alone. We are going to dissect exactly how that playground is built, starting with the most famous strategy of them all. It is a three-step dance that allows billions of dollars to skip a generation without triggering a single tax bill. It sounds morbid, but financially speaking, it is brilliant. Let's start with the strategy famously dubbed buy, borrow, die. It sounds like a grim nursery rhyme, but it is essentially the operating system for the top 0.1%. The first step is buy, but it really should be called accumulate. The wealthy buy assets that appreciate: stocks, real estate, artwork, vintage cars, basically anything that goes up in value over time. But here is the twist that trips up most normal investors: they never sell. I know, conventional wisdom says buy low, sell high. That is what we are taught. But in the tax world, selling is a sin. Selling is a taxable event. The moment you sell a stock that has doubled in value, you have realized a gain, and the IRS extends its hand for anywhere from 15 to 23%, depending on where you live. If you never sell, that gain is considered unrealized. It exists on paper. It contributes to your net worth. It gets you on the cover of magazines. But to the tax man, it is invisible. I have seen portfolios worth $50 million that generate less taxable income than a manager at a fast food chain. It is about patience. The wealthy understand that taxes are a drag on compounding. If you sell every year to rebalance, you are chopping off a portion of your snowball every time it starts rolling. By holding forever, they let the compound interest work uninterrupted. This is why you see billionaires holding the same stock for decades. It is not just loyalty to the company, it is an allergy to capital gains tax. But obviously, you can't buy groceries with stock certificates. You need cash to live. This brings us to the borrow phase, which is my personal favourite bit of financial wizardry. Since our billionaire friend hasn't sold their stock, they have no cash. So, they walk into a bank. The bank sees $1 billion in assets and happily offers a line of credit or a margin loan at a very low interest rate, often just a point or two above the benchmark. The billionaire takes this loan and uses it to pay for their lifestyle, the mansions, the private jets, the groceries. Here is the magic. Loan proceeds are not income. You do not pay tax on debt. In fact, getting a loan is a tax-free way to access the value of your assets. So they live off the bank's money while their underlying assets continue to grow, hopefully faster than the interest rate on the debt. It is arbitrage, pure and simple. Then comes the final inevitable step: die. I know, not the happiest ending. But for the heirs, it is a financial miracle. Under current US law, there is something called the step-up in basis. When the original owner passes away and leaves the assets to their heirs, the cost basis of those assets is reset to the current market value. Let's say Grandma bought a stock for $10, and it is worth $1 million when she dies. If she had sold it, she would have owed tax on practically the whole million. But when she dies, the heirs receive it with a cost basis of $1 million. The $999,000 of gain? Poof, gone, erased from the tax record forever. The heirs can sell it the next day and pay zero capital gains tax. It is the ultimate reset button. It basically rewards you for holding on to wealth until your last breath. Moving away from the billionaires for a second, let's talk about the millionaires and the savvy business owners. This is where things like LLCs, S-corps, and partnerships come into play. Most people think of these just as legal shields, ways to make sure that if someone slips on a banana peel in your lobby, they can't take your personal house. That is true, but the tax benefits are where the real action is. If you are a W-2 employee, you are taxed on the top line. You earn $1, the government takes its cut, and you spend what is left. Business owners play by a different equation: earn, spend, tax. They earn the money, spend everything they can legally justify as a business expense, and then get taxed on whatever is left over. It is a subtle shift in order of operations, but it changes everything. This is known as pass-through income. For many small to mid-sized business owners, utilizing an S-corp election allows them to split their money between a reasonable salary, which is subject to expensive payroll taxes, and distributions, which are not subject to those specific taxes. I have run the numbers on this for my own setup, and the difference can be thousands of dollars a year just by filing a different form. It is not a loophole. It is the structural design of the tax code to favor entrepreneurship. But the real power comes from what you can deduct before that income ever hits your personal return. This is where lifestyle design meets accounting. The IRS allows businesses to deduct expenses that are ordinary and necessary. Those two words are doing a lot of heavy lifting. Ordinary just means it is common in your industry. Necessary means it is helpful for your business. It doesn't mean you would go bankrupt without it. This grey area is where the wealthy thrive. A regular person pays for their car with after-tax dollars. A business owner might lease a vehicle through the company because they drive to client meetings. Suddenly, the lease, the gas, and the insurance are partially or fully deductible. The same goes for travel. If you fly to Aspen for a legitimate real estate conference, the flight and the hotel are business expenses. If you stay a few extra days to ski, you pay for those days personally, but the expensive part, getting there, was subsidized by your tax savings. I have seen people turn their hobbies into businesses just to capture these deductions. photography, consulting, even short-term rentals. The goal isn't always to make a massive profit immediately. The goal is to convert personal spending into business spending legally. There is a line, of course. You can't just buy a yacht, slap a logo on it, and call it a marketing expense, though people try. The IRS isn't stupid. But the wealthy have advisors who know exactly where the line is painted. They know that a board meeting held at a resort is deductible if the minutes are kept and the agenda is followed. They are essentially living a tax-advantaged lifestyle where the cost of living is discounted by their marginal tax rate. It is like having a permanent 30% off coupon for life's most expensive items, provided you can prove they help you make money. If you want to know the favorite word of every real estate tycoon from Manhattan to Miami, it isn't location, it is depreciation. This is, without a doubt, the most powerful wealth-building tool in the tax code, and it is completely counterintuitive. In the real world, things wear out. Your car gets older and worth less. Your laptop slows down. The IRS acknowledges this by allowing businesses to deduct the wear and tear of an asset over its useful life. For a residential building, the IRS says it lasts 27.5 years. So, every year, you get to deduct roughly 3.6% of the building's value from your income as if it were an expense. Here is the catch. Real estate, generally speaking, does not go down in value. It usually goes up. So you have an asset that is appreciating in the market, but for tax purposes, you are telling the IRS it is losing value. This creates a phantom loss. You might collect $50,000 in rent, cash in your pocket, but after you subtract the mortgage interest, the maintenance, and this massive depreciation number, your tax return shows a loss of $5,000. You made money, but you pay zero taxes on it. In fact, you can often use that paper loss to offset other income. It is the closest thing to alchemy we have in finance. You are turning a profit into a tax loss just by holding the building. And it gets even wilder when you introduce something called cost segregation. This is where you hire an engineer to walk through your building and say, "Hey, this carpet won't last 27 years, it will last 5. These light fixtures will last 7. When you do a cost segregation study, you are basically speeding up that depreciation. Instead of taking a small deduction every year for 3 decades, you take a massive chunk of it right now. I have seen investors buy a commercial property and, in the first year, write off 30 or 40% of the building's value. This can wipe out hundreds of thousands of dollars of taxable income instantly. This was essentially the bonus depreciation era we have been living through, though the rules on that are starting to phase down a bit. Still, the principle remains: accelerate the deduction to today, because a tax dollar saved today is worth more than one saved 10 years from now due to inflation. This is why you see wealthy people constantly buying new properties. When the depreciation on one building runs out, they buy another one to restart the clock. It is a treadmill, sure, but it is a treadmill that prints money. And remember that step up in basis we talked about earlier? It applies here too. If you hold that real estate until you die, all that depreciation you claimed, which normally the IRS would want to recapture or take back if you sold, gets forgiven. The slate is wiped clean. So you got decades of tax-free income, and your heirs get the asset at full market value with no tax baggage. It is a staggering advantage over someone renting an apartment and putting their savings into a savings account. One is building a tax bomb, the other is building a tax fortress. You can see why real estate is the foundation of so many family fortunes. Now we enter the realm of the truly sophisticated, the stuff that requires lawyers who charge by the minute, not the hour. Trusts. A trust is basically a virtual box where you put your assets, and you give someone else the keys to manage it for the benefit of a third person. It separates ownership from benefit. One specific tool the ultra-rich love is the GRAT, the Grantor Retained Annuity Trust. It is a mouthful, but think of it as a freeze ray for your estate taxes. Let's say you have $10 million in stock that you think is going to explode in value. If you just hold it and it grows to $50 million, that growth is in your estate and will be taxed heavily when you pass it on. Instead, you put that 10 million into a GRAT for 2 years. The trust pays you back your 10 million plus a tiny bit of interest set by the government. If the stock goes up way more than that interest rate, all that extra growth, the upside, passes to your kids tax-free. If the stock crashes, you just get your assets back and try again. It is a heads I win, tails we don't lose bet. Mark Zuckerberg and the founders of practically every major tech company have used these to transfer billions of dollars to their heirs without paying gift tax. It is perfectly legal, mathematically sound, and completely out of reach for someone whose main asset is a checking account. Then there are dynasty trusts. Most trusts have an expiration date, but in certain states like South Dakota or Delaware, you can set up a trust that lasts forever. Dynasty trusts allow wealth to cascade down from great-grandpa to great-great-grandkids, skipping the estate tax at every single generation. It creates a permanent pool of capital that supports the family line indefinitely. But perhaps the most overlooked tool is life insurance, specifically private placement life insurance, or PPLI. Forget the term life policy you bought to cover your mortgage. PPLI is essentially a hedge fund wrapped inside an insurance policy. Here is the logic. Inside a life insurance policy, cash value grows tax-free. You can trade stocks, buy crypto, or invest in hedge funds within the policy, and the IRS doesn't touch the gains. Then, you can borrow against that cash value tax-free while you are alive. And when you die, the death benefit pays out to your heirs tax-free. It is the trifecta of tax avoidance. The catch is that you need massive amounts of capital to even set one up, usually millions up front, and the fees are high. But for the super rich, the fees are peanuts compared to the tax savings. It effectively turns high-tax investments into tax-free ones. It is like having a Roth IRA with no contribution limits. While the average person is capped at putting away a few $1,000s a year into tax-advantaged accounts, a wealthy individual can dump 10 million into a PPLI structure and never pay tax on the growth again. It is strategies like these that widen the gap. It is not that they are smarter, it is that they have access to financial products that act like cheat codes for the tax system. Let's shift gears to something a bit more active. Timing. Most people file their taxes once a year, usually in a panic in April. The wealthy are thinking about taxes every single week. One of their primary tactics is tax loss harvesting. It is the financial equivalent of making lemonade out of very sour, rotten lemons. Let's say you bought a tech stock that tanked. You are down $5,000. A normal reaction is to hold onto it and pray it comes back, because selling feels like admitting defeat. The wealthy investor looks at that loss and sees an asset. They sell the losing stock to realize the loss. Why? Because that $5,000 loss can be used to offset $5,000 of gains from another investment. If they made a profit selling real estate or another stock, this loss cancels it out, saving them the tax bill. If they don't have any gains to offset, they can use up to $3,000 of that loss to offset their regular income, their salary. And if they have even more losses, they can carry them forward into future years. They are banking tax credits for a rainy day. The twist is that they don't actually want to be out of the market. So, after they sell the loser, they immediately buy a similar, but not identical, fund to stay invested. They keep their market exposure, but capture the tax benefit. It is a game of musical chairs where they deliberately sit on the floor for a second to pick up a tax credit. Beyond just harvesting losses, the wealthy are masters of timing when they receive income. If you have a job, you get paid when your boss pays you. You have no control. But if you own a business or have complex investments, you can often choose when to realize income. Maybe you had a massive windfall this year. You sold a business or had a great bonus. A smart tax planner will tell you to prepay as many expenses as possible this year to lower that spike. Or, If you know next year you will be in a lower tax bracket, maybe you are taking a sabbatical or retiring, you defer income until January 1st. It is about smoothing out the peaks and valleys. The tax code is progressive, meaning the more you make in a single year, the higher percentage you pay. By spreading income out or shifting it to low-income years, you pay a lower average rate over your lifetime. This is also where geographic arbitrage comes in. If a wealthy individual is planning to sell a company for $50 million, they might move from California to Texas or Florida a year before the sale. That move alone saves them over $6 million in state income taxes. That is a $6 million U-Haul rental. They are matching their biggest financial events with the most favorable tax environments. It requires foresight. Most people live life and then do their taxes. The wealthy do their tax planning and then live their life accordingly. Now we have to talk about charity. I want to be clear. Many wealthy people are genuinely generous and want to make the world better. But it is also true that philanthropy is one of the most effective tax reduction strategies in existence. The government effectively subsidises your giving. The most basic version is the charitable deduction. If you are in the top bracket, every dollar you give saves you 37 cents in federal tax. But the pros don't just write checks, they donate appreciated assets. Let's go back to that stock you bought for $10 that is now worth $100. If you sell it to donate the cash, you pay tax on the $90 of gain and the charity gets less. But if you donate the stock directly to the charity, two magical things happen. First, you get a tax deduction for the full $100 market value. Second, nobody pays the capital gains tax. The charity is tax exempt, so they sell it and keep the full 100. You wiped out a tax liability and got a deduction simultaneously. It is efficient. Then there are donor-advised funds, or DAFs. These are like charitable checking accounts. You can dump a huge amount of money into a DAF in a high-income year to get the massive tax deduction immediately, but you don't have to decide which charity gets the money yet. The money sits there, growing tax-free, and you can dole it out to the local animal shelter or university over the next 20 years. You front-load the tax benefit. For the ultra-wealthy, DAFs are just the starter pack. The heavy hitters set up private foundations. Think the Gates Foundation or the Ford Foundation. A private foundation allows a family to donate millions, get the tax break, but retain control over how that money is invested and distributed. They can hire family members to run the foundation, paying them a salary, and travel to conferences to study charitable causes. While there are strict rules against self-dealing, a foundation essentially allows a family to build a legacy institution with pre-tax dollars. It converts private wealth into public influence. And let's not forget charitable remainder trusts. This is where you put assets into a trust, the trust pays you an income for the rest of your life, and whatever is left when you die goes to charity. You get an upfront tax deduction, a stream of income, and you get to feel good about the end result. It is a way to have your cake, eat it, and then donate the crumbs to a good cause. When you stack all these strategies, buy, borrow, die, depreciation, trusts, harvesting, and philanthropy, you start to see the full picture. The wealthy aren't just lucky. They are operating in a tax environment that has been engineered to preserve capital. They turn expenses into deductions, income into capital gains, and estate taxes into charitable legacies. So, where does that leave us? If you are not sitting on $100 million, this can all feel a bit discouraging, maybe even infuriating. But getting mad at the tax code won't lower your bill. Understanding it might. While you might not be able to set up a Cayman Islands trust or use a PPLI structure, the principles apply to everyone. First, shift your focus from income to assets. Income is the highest taxed form of money. Capital gains are lower, unrealized gains are zero. The more you can move from being a wage earner to an owner, whether that is stocks, a small business side hustle, or real estate, the more control you have. Second, use the tax-advantaged accounts you do have. The 401k, the IRA, and especially the HSA, Health Savings Account, are your personal tax shelters. The HSA in particular is triple tax-advantaged. Tax-free in, tax-free growth, tax-free out for medical. It is the closest thing a regular person has to a billionaire's loophole. Third, think about timing. Can you bunch your charitable donations into 1 year to itemize? Can you harvest losses in your brokerage account to offset a good year? You don't need a team of lawyers to do this, you just need to pay attention. And finally, be curious about business structures. In the gig economy, almost everyone has some form of self-employment income potential. That opens the door to the ordinary and necessary deductions we talked about. The biggest takeaway isn't a specific loophole, it is a mindset. The wealthy view taxes as a variable expense, something to be managed and minimized, like electricity or shipping costs. Most people view taxes as a fixed penalty they have to suffer. By switching that mental flip, you start asking better questions. You start looking at $1 saved in taxes as worth more than $1 earned in wages, because you don't have to work for the savings. I want you to look at your own finances this week, not with dread, but with the cold, calculating eye of an asset manager. Where is your drag? Where are you leaking efficiency? It takes time to build this structure. It took the tax code 100 years to get this complicated. You won't master it in a weekend. But every step you take toward tax efficiency is a step toward keeping the wealth you create. If you found this breakdown helpful, or if you have a specific strategy you have used to lower your own bill, I want to hear about it. Drop a comment below. Let's create a bit of a peer review section down there. It helps me know what deep dives you want next, and frankly, it holds you accountable to actually apply what you learned. And if you haven't yet, hit subscribe. We are going to keep decoding this system until the complex feels simple. Thanks for watching, and here is to keeping a little more of what you earn.